What's going on, guys? Welcome back to another video here. This video is going to be incredibly important for kind of the narrative that we've been talking about over the last couple of weeks here and on Twitter, not just on these YouTube videos. So we are finally starting to see these reinflation risks starting to emerge and the key catalyst for what could cause these fears to arise in the market. Now, why have we been talking about this? Well, obviously, a lot of you guys have been wondering what my thoughts are surrounding the bond market, TLT, TBT, TMF, because we've been pretty spot on with a lot of those calls throughout this year. And I don't see that changing anytime soon. Now, this is also really important as to how it relates to the equity market and how it could react as well. So guys, we have a lot to get through today. So if you wouldn't mind dropping a like down below if you guys do enjoy these types of videos that I post here, and subscribe if you want to see more. And also, I gotta give a shout out to you guys in the Discord. You guys have been absolutely crushing it. Last week was probably one of the most insane weeks that I've seen you guys have. I'll throw some screenshots up right here. We had the long China trade, which I'm personally up over $12,000 right now on the yin position, which has been awesome. The 900% Pinduo duos, the 485% Nvidias, the Teslas, the CRMs today. Guys, if you guys do want access to all of the course curriculum videos, the private live streams, the pre-market plans, the macro research reports, the watch list of stocks that are about to explode before they do, the single stock research reports, there's a lot in there, and limited time offer team. I am going to be offering everybody 50% off their first month with code BULLISH. So if you are interested in that, make sure you guys check out that link down below. But I just really love looking at this yin chart right here. This has been an absolutely awesome trade to be in. So first things first, I want to take a brief look at the chart of the 10-year treasury yield right here. In yesterday's action, just overall in the bond market was incredibly important. The main term that I want you to keep in your head is flight to safety. We did see gold moving to the upside. We saw oil moving up, which is going to be very important for this reinflation narrative that we're seeing. We also saw bonds moving to the upside, yields moving lower. Again, bond prices and bond yields are inversely correlated. So when we do see this additional demand for bonds and we see large movements in 10-year treasury yields, especially in this case here, that is going to signify a little bit of a flight to safety. Now, why was this happening? Well, there's two main reasons, and these two reasons are also going to potentially lead to these reinflation risks. So when we move over here, we have the escalation in the Middle East. Now, as of right now, the market has kind of brushed off any of these kind of smaller scale skirmishes and retaliations that have been happening. And I think that's going to continue to be the trend until, or hopefully not, but if we do end up seeing really large scale escalation in all of these conflicts happening. Now, what did this do to certain aspects of the market? Well, as you guys can see, we did see some significant volatility and a pretty significant move up in oil. Now, oil right now had a pretty significant green day to the upside here, then started to move back down. Now, this is a key if here. If we continue to see these conflicts escalate and oil continues to move to the upside like we have seen over the last couple of days here, that is going to be inflationary. Oil is a key component of a lot of units of production, transportation, moving goods around in order to get them to their end location in order for them to be sold. Oil going up is not going to help get inflation back to the Fed's target. So oil is the first little reinflation fear that we have. If oil continues to move up here, that is definitely going to add to some reinflation fears. Now, remember, the market is still pricing in an aggressive amount of rate cuts over the next quarter, 2 or 3 quarters here. So if we are to see those reinflation risks and fears start to occur, well, obviously those are going to have to get priced out. We would see bond yields move to the upside and potentially equity markets sell off. That's why this is really important. Now, the almost more pressing issue that I see is, yeah, the market is kind of understanding what's happening with these escalations, and it's probably going to continue brushing them off with some short-term volatility, but this port strike is incredibly important. The port worker strike could cost billions. Here's what to know. It's not just billions, it's like $7.5 billion every single week, which we'll take a look at here. So let's just break down this situation. We had 45,000 members of the International Longshoremen's Association begin their strike on Tuesday, affecting 14 ports. the key part about these ports, which is important, is that it does say it somewhere in here. Let's see if we can scroll down. The ports involved in the strike handle about 14% of all agricultural exports in the U.S. and 73% of all imports. And as you can see up here, about $7.5 billion per week is what this International Longshoremen's Association strike could cut from the U.S. economy. Okay, let's think about this here. Let's break this down. There's been a lot of strikes that have occurred, but not necessarily to this scale. There was an offer made to the Longshoremen's Association to give them a 50% increase in their wages, and that was declined by the association. They are looking for around that 70% increase range. Now, why is this really important right here? The ports involved in the strike handle about 14% of all agricultural exports in the U.S. and 73% of all imports. Demand for these goods that are coming into all of these ports in the United States with the current economic conditions is not going to change. But what is going to change is the supply. If you have a significant supply shock, either moving up or to the downside, well, that's going to influence price, especially if demand is going to stay the same. So in this example here, if we see supply moving lower, demand staying where it is, macroeconomics 101 is going to tell us that prices should then naturally increase. So, understanding these two different elements that are occurring in the market right now, that we have the International Longshoremen's Association strike, the port strike that is occurring across the country that affects 73% of all imports in the United States, is incredibly significant. Now, this is going to take a little bit of time in order to play out. If they are able to come to some sort of agreement and reopen these ports here, obviously those reinflation risks and those fears might subside, but we haven't even seen the reinflation fears yet. As a well-rounded market participant, like hopefully a lot of you guys are becoming from watching these videos, participating in the Discord and the live chats there, which I know a lot of you guys are, we have to understand every single risk that is out there in the market at any given time. We can't just sit here and say, oh, the market's at all-time highs, everything is fine. That is not a great way to operate in the market. We want to make sure that we understand the best and worst case scenarios at any given time. Remember, we were talking about the USD JPY situation for a while, and how yen is coming back up, and how this could be another catalyst for some selling in the US markets. We've been talking about this a lot in the private community. We are out of the danger zone for this catalyst, so that's good. That's a good thing. But now we have two new ones reintroduced with escalation in the Middle East, moving oil prices a little bit higher here, and then also the inflationary elements of these supply shocks that are going to be happening as a result of these ports not being able to process a lot of these goods and get them out into the economy. Now, I also want to take a brief look at the overall market here. When we're looking at ES, and I want to make sure my video isn't losing its mind. I need a new computer. When we are looking at ES here, it's in a weird spot. The S&P 500, we're in an interesting spot here. So we are holding right above the daily 10 EMA, which is a good sign that we are holding. But going into the rest of the week, we do have non-farm payrolls on Friday that we are going to have to be aware of, and how that is going to cause the market to react. In general, we see this theme happening in the market recently where the jobs data is taken with a grain of salt due to the insane amount of revisions or the number of revisions that are actually happening, the volume or the magnitude of these revisions. That's a better way to put it. 800,000 job revisions to the downside in the labor market. It's not necessarily what you want to see. And again, we're probably going to see the market have some significant volatility on Friday because a lot of people are going to be thinking on one side, well, that data could be correct and react accordingly. And then on the other side, they're going to be thinking, well, that's the best that you could cook the books. So it's going to take a couple of days after Friday in order to figure out, okay, how is the market actually digesting to that? But again, not really the most pressing issue here, with the potential for oil to keep moving to the upside and the inflationary pressures that are going to be pushed onto the markets with this port strike. So the mistake that the market is making right now, and the mistake that they made yesterday, which is why I wanted to bring this up first here, so we can kind of go full circle with this before we wrap up. The mistake that the market made was assuming that this flight to safety trade was going to last. They are discounting the fact that the two catalysts that were causing markets to have some volatility yesterday and that flight to safety trade results in reinflation. So what would that actually naturally do to bond yields and bond prices? Well, bond prices would move down, bond yields would then move to the upside, which is exactly what we are seeing today and what I highlighted on Twitter last evening. So team, that is going to wrap it up for this video here. Again, if you have any questions on anything, just drop a comment down below. I will do my best to answer all of your guys' questions. But until next time, I will see you guys. Peace.